My name is Jake. Welcome to the channel. When you invest in a dividend growth strategy, you're looking to live off of the passive income from your dividend portfolio. That's the whole goal of why we invest into dividend stocks, so that we can live off of the portfolio, so that we can live off of the dividend income, and so we don't have to sell our shares at the right time. Okay, so when I first started learning about dividend investing, I didn't really understand the concept of your time horizon and how important investing based off of your time horizon is, because what you notice, or what I noticed was, when you go on YouTube and you watch these other YouTube videos, right? You watch these dividend investing videos and they're like, these are the 5 top dividend stocks for April. These are the 10 best dividend growth stocks, blah, blah, blah. Like, that really didn't help me when I first started learning about dividend investing, because I didn't really fully understand what my investing time horizon was. So before you start looking at what the top 5, dividend stocks for April are, I think it's important that you understand how to invest based off of your time horizon. So the goal of this video is really to help new investors that are looking to start out or start to build a dividend portfolio based off of their time horizon. Investing can be stressful. It can be intimidating. I understand when you're first starting out, it can be very hectic. It can be very stressful, and you're looking for answers to questions that you have, and you're not maybe finding those answers, and it could look a little like this.
Well, I mean, you're a plumber, right?
Oh, yeah. Well, I know exactly what to do. Mario, Scabelli's flooding the site.
We need your help.
Scabelli. Strap your belt on, kid. We're going in.
Oh my gosh. Now that we all got our belt strapped on, let's take a look at some investing portfolios here and let's dive into the video. So in my portfolio here in M1 Finance, I take a hybrid approach, right? I shared this in my last video. I invest into individual companies as well as into ETFs. And so in this video, we're just going to talk about building out a dividend growth portfolio with ETFs. And if you're not 100% sure what an ETF is a basket of stocks that you buy an index, right? And so instead of buying one individual company, you have the option to buy an index. And so what you're doing is you're buying all of the companies in that index, and you're getting immediate diversification by buying the index. And you're not taking all of the risk when you invest into an individual company. So if you wanted to invest into a candy company or a basket of candy companies, you could get instant exposure to every single candy company in the world by buying, for example, an index. And I don't know what the heck this is. I don't know where this website was from, but I definitely am not the biggest fan of Airheads. I do like Kit Kats. I do like Reese's Pieces. I like Butterfingers. What is this? Anyways, M&Ms are good. Haribo Peaches. Oh my gosh. Haribo Peaches are really good. What are these? Candy cigarettes? I don't know about that. Dots, Jack Links, Nerds, Cheez-Its. Oh my gosh. Do you agree with this? I don't know if I agree with this. I don't know if Airheads are my favorite candy. Airheads, Arizona, Texas, North Carolina. Why does so many states like Airheads? I don't know if this is true. Is this true? Let me know. Let me know if this is right. Which state are you from? Do you agree that candy corn is your favorite candy? All right. So before we dive into the individual portfolios here, it's important that you understand the rule of 72. So I'm just going to touch on this very briefly. The rule of 72 is how long it takes an investment to double, right? So if an investment has a return, an annual return of 1%, it will take you 72 years for that investment to double. If an investment has a 5% return, it will take you just around 14 years for that investment to double. If an investment has a 10% return, it will take on average around every 7 years, your investment will double. Okay. And so if your investment has a 15% return year over year, your investment will double every 5 years. So the reason why this is important is you have to understand, if you have a long-term time horizon, you want to focus on an investment that is growing faster. Maybe it's a little bit more volatile, but it's growing faster. For example, you talk about a lot of retirees, they go and they want to invest into something a little bit more secure, a little bit less risky. Maybe they invest into bonds or treasuries. Those investments are compounding at a much slower rate, and therefore, they're going to be less volatile, but they're going to grow slower. And the reason why this is important is based off of your time horizon, you have to kind of understand about what level of risk you should be taking when you're looking at different investment options. If you're curious around, how to find the dividend growth rate, and this will make sense a little bit further into the video because I'm going to talk about dividend growth rates. When I talk about the compounding nature of an investment, there's two pieces to it. There's the total return, that is the share price, the capital appreciation, plus the dividend, because the dividend is part of the total return. And the other part is just the dividend. So the dividend compounding annual growth rate, this is what I'm going to primarily be talking about in this video, is just the growth of the dividend. But if you want to see and understand how quickly an investment is growing, I like using Seeking Alpha. If you type in the ticker of the company that you're interested in or the ETF, go into the dividends tab, go under dividend growth, and you can see how quickly this investment is growing. And you can see here year over year, for example, SEHD, the ETF has grown at a different rate, depending on the year that you're looking at. Here over the last couple of years, SEHD has just exploded. So it's a really, really high quality, high dividend growth ETF. But this is just one example of how you can find out the dividend growth rate. And the reason why I'm sharing this is I don't want you to just watch this video and then just blindly copy the dividend, the ETFs in these portfolios. The reason why I'm sharing this with you is I want you to use your brain. Right? I want you to have your own critical thinking. You understand your risk tolerance better than I do. You understand your time horizon. I want you to take this information and I want you to be able to implement it and have it help you when you're building out your portfolio. So before we dive into these 4 portfolios, I want to go over a few assumptions. This is important because it will add a little bit more context to what we're talking about here. So the first assumption is when we're going over these portfolios is that these are in a taxable account. The second assumption here is this is just a sample portfolio and it can and should be adjusted based off of your personal timeline and your personal risk tolerance. Because I don't know your risk tolerance, only you know that. And so this is important that you understand that when you're looking at these portfolios. The third thing here is that someone that's investing in this type of portfolio, I'm assuming that you also have a 401k and a Roth IRA. Or an IRA, for example, in a low-fee, broad-based index fund like the S&P 500. So I'm assuming that you have, in addition to this, a tax-sheltered account or a retirement account that you're funding. The fourth assumption here is I'm assuming that you're not lump sum investing. I'm assuming the majority of people watching this video, you're dollar cost averaging from your day job. And then the fifth assumption is that I'm assuming that this investment strategy is a buy and hold strategy. And so this is important for tax reasons and others, but I'm assuming that you're not going to buy and sell into this portfolio, but rather this is a buy and hold forever type portfolio. All right, let's take a look at the first portfolio. This portfolio has a time horizon of 0 to 5 years. So this is ideal for somebody that is looking to live off of the dividend income in the next 5 years. You'll notice that this portfolio has 7 holdings in it. It has a starting dividend yield of 5%, and it has it has a decent expense ratio. And so the 7 ETFs in this portfolio are VYM, SCHD, VNQ, QYLD, RYLD, DGRO, and JEPI. All of these ETFs I personally own in my portfolio. This portfolio is a great balance between growth and current income. The QYLD, RYLD, and JEPI, these are covered call ETFs. The taxation of these ETFs are a little bit less favorable than VYM and SCHD, for example. But the thing that I like about this portfolio is you're getting a balance between the current income and the growth of this portfolio. So the reason why that's important is you're getting the income today, a high starting yield of 5%, but this portfolio is going to continue to grow 5, 6+% year over year as the portfolio organically grows and compounds over time. And so, for example, if you're living off of this portfolio today, you will be getting more dividend income in 5 years without having to ever reinvest a single dollar. So that's the key thing when it comes to this portfolio. And the important thing that you have to understand, this portfolio serves really one main purpose, is it generates income while also still maintaining a balance of growth over time. The second portfolio here is for a time horizon between 5 and 10 years. You'll notice here that there's 5 holdings in this portfolio, and the dividend yield, the starting dividend yield is 3%, and it has a lower expense ratio. In this portfolio, we have similar ETFs. We have VYM, we have SCHD, DGRO, VNQ, and JEPI. So the big difference here is you don't have those high dividend cover call ETFs in QYLD and RYLD. And so this portfolio here is going to be a bit more tax efficient, though you still do have VNQ and you do have JEPI, which are taxed a bit different than DGRO, SCHD, and VYM. But the thing that I like about this portfolio, this is a well-balanced portfolio. It's skewed a bit more towards growth, though it still does have an income component to it. With JEPI adds a good layer of consistent dividends month over month, and it has a higher starting yield. But because there's so much focus on VYM and SCHD and DGRO, this portfolio will continue to grow at a much faster pace than the last portfolio that we saw. And so if you have a time horizon of 5 to 10 years, this is the type of portfolio mix that you should be ideally looking for. It doesn't have to be exactly this, but this is kind of the mixture that you should be looking for when it comes to your specific time horizon. Now, one thing that you could do, if you wanted to even optimize this a bit more for tax efficiency, is you could take out VNQ entirely and just put VNQ in your Roth IRA, for example. And that could be one way that you could even make it more tax efficient. So for example, if you're a high earner, or if you plan on having a $3 or $4 or $5 million portfolio, and you know that you're going to be in a higher tax bracket in early retirement, then yeah, absolutely, it makes sense to put VNQ into a tax sheltered account. But if you plan on building a $1 to $2 million portfolio, and you plan on generating maybe $75,000 to $100,000 in dividend income, I think having VNQ in there is actually not a big deal, because the way that the tax structure is set up, you're not going to be paying as much in taxes that you would think, because you're at a lower tax bracket when you retire. Okay, I'm not going to get too far in the weeds there. If you are interested, or if you're curious of what I mean by that, go over to my YouTube channel, scroll down in the videos tab, and take a look at this video right here. Pay 0 taxes in early retirement. If you're unsure about what I mean by that, if you don't want to pay any taxes in early retirement with a taxable account, watch this video and I explain it in more detail. All right, let's take a look at the third portfolio with a 10 to 15 year time horizon. Now, the thing that you'll notice right off the bat here is the timeline is a little bit further out. It has a decent performance here over the last 5 years. It has a strong dividend yield with that return, right? And 83% over the last five years. This is on pace, very comparable with the S&P 500. Very comparable. It has a lower expense ratio, and it has 4 holdings. So now, when we look at this, 10 to 15 years is a long time. I don't know about you, but 10 to 15 years, I have a hard enough time planning what I'm going to have for breakfast tomorrow. 10 to 15 years, long time. And so when we're looking at this portfolio, for me personally, if I were to think, okay, I'm starting tomorrow and I want to build out a dividend growth portfolio and I plan on working for the next 10 to 15 years, I would want to keep it very simple. And for me, how I would prioritize this is I prioritize tax efficiency. So I'm not going to have any REITs in here. I'm not going to have any cover call ETFs in here. I want tax efficiency. And so in this portfolio, we have SPYG, and all of these are equally weighted. SPYG, this is the S&P 500 growth ETF. We also have VYM, SCHD, and DGRO. So the thing that I like about this is you're skewed more towards growth, but you still have a healthy dividend. You have a higher dividend than the S&P 500. I think most people watching this video are probably gonna, this is probably going to be the most applicable to those watching my YouTube channel. When I look at this, the analytics of who watches my videos, it's anywhere from about 25 to 45 years of age are usually the people watching my channel. And for most people watching my channel, this is going to be the portfolio that would make the most sense if you have, for example, a 10 to 15 year time horizon. And once again, this is very, very tax efficient. You can hold this in a taxable account and you are getting the best tax treatment that you can get when investing in a dividend strategy. All right, on to the last portfolio. If you have a 20 plus year time horizon, this is the portfolio for you. The thing that you want to notice here is the performance. This is not with the dividend reinvested. Okay, this is just the share price. This portfolio is up over 120% and it has just over 1.25% dividend yield. It has a low expense ratio and it has 5 holdings. When looking at the total return of this portfolio is beating the S&P 500, and I will show that here in just a second. But when you look at the 5 holdings in this portfolio, 20 years is a long time. I don't know what the world is going to look like in 20 years. And so for me, this portfolio is focused on a conservative growth. The highest holdings in this portfolio are going to be VTI. VTI is the total stock market. The second one here is SPYG. And then the third one is VGT. VGT is personally my favorite growth ETF. This is one of my largest holdings in my Roth IRA. I have a 25-year time horizon with my Roth IRA. My largest holding is VGT and also actually VTI. So I own both of these in my Roth IRA. DGRO at 15% and SCHD at 10%. And also when looking at the tax efficiency here of this portfolio is skewed for tax efficiency. So this is a portfolio that you could hold in a taxable account and you would get very good tax treatment on the dividend here, on the dividend income. And so how does this fourth portfolio with a 20-year time horizon compare to just investing in the S&P 500? So, looking back since January of 2015, now I understand this is not a long time. I think one of the ETFs in here has not been around longer than 2015. So take everything with a grain of salt when it comes to these numbers. But when you back test this portfolio back around 7 years, back to January of 2015, if you compare investing just in the S&P 500 versus investing into VTI, SPG, VGT, GGRO, and SCHD with the following allocation, right? As I mentioned in the portfolio there. The portfolio number 2 here, this portfolio is actually beating the S&P 500. If you would have invested $10,000 in January of 2015, you would have seen a 13.5% compounding annual growth rate. This is the total return. So the capital appreciation plus the dividend reinvested, you would have seen a 13.5% CAGR. But with this portfolio, you would have seen just over a 16% CAGR. So this portfolio has actually outperformed the S&P 500. So if we were to sum this all up, if you have a 0 to 5 year time horizon, you ideally want to look for an investment that has a 4 to 6% dividend yield. And you want to focus on the dividend that is growing anywhere from 5 to 7%. So whether you're investing just into ETFs or you're investing into individual companies, it's important that you kind of look at that range. And when I say important, this is just my personal opinion, right? When I am building out a portfolio and when I'm thinking about compound rates, this is what I personally focus on. So take everything that I'm saying with a grain of salt. This is just my personal opinion. This is not by any means like the one and only way to do this. But if you're just starting out and you're just starting to build a dividend portfolio, I think this is a great way to get started and to kind of guide you when you're looking for different investment types or vehicles of what you should be kind of filtering by. And so that's just, how I personally would do it if I were, building out a dividend portfolio. So looking at 5 to 10 years, ideally looking, or for me personally, I'd be looking for a 3 to 4% dividend yield with a dividend CAGR of around 7 to 9%. And, that's a really good, CAGR. 7 to 9% with a 3 to 4% dividend yield. That is massive. Like, that's really, really good still. And a 10 to 20 year time horizon, I would be personally looking for a 2 to 3% yield with a dividend CAGR of over 10%. Keep in mind, we're not talking about buying and selling. The goal here is that you're going to buy and hold and never sell. So if that's your goal, like these are some, I personally would try to stick around this range. And then if you have 20 plus years, this could vary greatly if it's 20 years or 40 years. So anywhere from 0.5% to 3% starting dividend yield and a dividend CAGR of over 10%, I think is a really, really good range. So the difference between 20 years and 40 years is massive. So you just kind of have to figure out what's right for you. But for me personally, these are kind of the ranges that I would be looking for. And I think this should guide you when you're looking at different ETFs. You can see the historical performance, right? What you want to make sure that you're doing is you're not just looking at the total return, but you're also looking at the dividend growth rate. The reason why that's important is if you plan on never selling your shares, you really want that dividend growth rate growing and compounding over time. Okay, really, really important. Some companies, they grow their share price really well. They don't grow their dividend very well, and vice versa. So you want to make sure that you kind of find that sweet spot. And for me personally, based off of your time horizon, this is the sweet spot. But yeah, thank you so much for watching, everybody. I hope that this was helpful, and I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.